usually we conduct our classes on Sunday mornings. My subject, the session is on Sunday morning, and that runs for 2.5 hours. Early morning at 7 a.m. to 9:30 a.m. But given this current situation, we are not meeting each other in person, and also we are in a virtual environment, which is very strange and a new experience, because I'm only talking to a computer screen. I can't see any of your faces, so I don't know to whom I'm talking to actually. So, but we have to adjust to this new environment, and hopefully things will be settled very soon, and we will be able to meet you in person, and also have some very close interaction in the class, two-way interaction, because this class we cannot run as a one directional class. We have to have some discussions. I have to get your feedback. I have to give you some exercises within the class, and it's basically an uh, interactive environment. But given the current situation, we will settle with this environment and the situation, and hopefully we will be back to normal very soon. So this subject, introduction to the financial system, an overview today, that is our session. But if I give you some basic understanding about the subject and our scope today, that will be our basic framework for today's discussion, to have some overview on the subject. So okay, now let me introduce myself. I'm the regular lecturer of this session, Survey of Financial System. My name is Anil Pereira. I'm an additional director of the central bank. I'm working for the domestic operations department, and actually this is my 8th year at the IBSL. So during last 7 years, I have been teaching this subject. Every year we have 2 semesters, so this is my basically 14th semester teaching at the IBSL, the same subject. Uh, as I said, I'm working for the central bank, the domestic operations department. That is basically dealing with the banking sector, my department. Earlier, I was working with the research department, where we have been doing some research on the economy, broader economy and macro variables, and also studying and monitoring various aspects in the economy, doing some research. So that was my main task, and I was heading actually the money and banking division of the research department. So which means I have been working with the banking sector and the financial system very closely. Even now, my department is an operational department where I broadly monitor the operations in the domestic money market, again banks and some related institutions. So in that sense, I have some practical experience in the banking field as well as the markets. So in that sense, I think I have some reasonable uh, exposure to the financial market to teach this subject. And in terms of my education, I got a PhD from Monash University, and again that is on banking and economics. So that is also giving some additional support for me to conduct this lecture. So I think you can see me on the screen. This is actually before the lockdown. Now if I see me, if you see me, I'm a little bit different, but hopefully I'm also back to I will also be back to normal very soon. Okay. This subject, 101, Survey of Financial System, this is one of the compulsory subjects, which means core subjects of this course. So you are in the IABF program, Intermediate in Applied Banking and Finance, where you have to complete 6 subjects under this level, 4 compulsory subjects and 2 optional subjects out of 4 subjects. So compulsory subjects, we have survey of financial system, commercial banking, business accounting, introduction to banking and financial law. So those are the core subjects or the compulsory subjects. Out of that, the survey of financial system is one of the compulsory subjects. So you cannot avoid this, you have to study. So what is the basic overview of this subject? Now, I think you now in terms of our traditional or usual classes, what I do is at the beginning, I have some discussion with you on the very first day. Basically, discussion on your background. Who are you? What are you doing? What's your name? Where are you from? What are you studying or have studied? Likewise, I get to know about each student in my class, and I'm doing that with a purpose because I need to understand your backgrounds and your uh, education in terms of your earlier engagements with in the school, and as well as if you are a university student, what is your background. If you are working, what is your background. Likewise, I have a discussion with you usually. The purpose is I want to get some idea about your background in order to create a very dynamic environment in this class, which means I have to make it very customized according to your knowledge. For example, if I realize you are having some very basic understanding about the financial sector, probably I will also go into some basics and customize my discussion. And if I get to know that you have some reasonable understanding about the financial system, my approach will be a little bit different. But today, unfortunately, we don't have such environment to get to know about each other. My assumption or the presumption today that I think you have some sort of basic understanding about the financial system in the economy. Now, financial system is a part of the broader economy. So economy has various, sectors. We have the external sector where we have, imports, export, and foreign investments, all these things. We have a real sector in the economy, basically where you deal with, production of goods and services and trading those goods and services, employment. And also we have a fiscal sector in the economy where we have the government finances, their revenue, basically taxation, their expenditure, and deficit financing. All these are related to the fiscal sector. And also we have a monetary system where you have monetary sector where you have the transactions in the monetary sector. So broadly, monetary sector means it's indicate or that is relevant to the financial system in the economy. Now, financial system in the economy is facilitating economic activities by providing services of money and finance. As I said, the monetary sector is basically the part of the financial sector. So if I say money or finance, that broadly indicates a one particular sector which gives some support to economic activities. Why do we say it gives some support to economic activities? Now, in the economy, when people do the production, that production has to be exchanged in the economy. If you do a production, that has to be traded in the economy. Now, in the past, when you have this production, the only possibility to trade is basically exchanging goods for goods. For example, if I have a production of fish, I may exchange such fish with some other party who's having rice. So I'm exchanging fish and rice, which means I'm simply exchanging goods, or you call it bartering, barter system, exchanging direct goods. Services, of course, you can't really exchange, but goods you can. So it's a very primitive, limited type of a transaction. In such economy, you cannot do a large volume of or large actions of economic activities because you are really limited. Throughout the human civilization through the history, we have seen the world has been, moving. The systems have been evolving. Similarly, financial systems have evolved, and during this evolution, what really has happened, this direct exchange of goods and services, goods actually, it was supported or replaced by a commodity or some intermediate thing like we call as money. So money was the origin, or the money was the basis of finance. Why? It facilitated the economic transaction uh, through an intermediary uh, commodity. For example, a piece of metal. For example, some natural item. So those were introduced as money, and that money has evolved throughout the history. Now today we know the money, even money is in virtual form. So it has evolved throughout the history. So in that sense, the finance has also evolved throughout the history. Now, with that evolution, the role of finance has also been advanced or changed. Now, in the modern world, the finance is, simply uh, not only this money. There could be various aspects of finance. If you take the financial system, there are various, subcomponents of the financial system. So all these subcomponents as a part of finance supporting economic activity. So we can very safely say the interaction between the economic activity, what we called as real economy, the real economy, and the financial sector is important for the overall macroeconomic performance of a country. In other words, interaction between real flows of the economy. Real flows means goods, services, and if you like, you can add factors of production as well. All these are real flows. And the relationship between these real flows and the financial flows will decide the level of macro performance of a country. And what we are trying to do this year is we try to understand the operational mechanism of this financial system. So under this subject, we are basically trying to understand the operational mechanism of the financial system. We are not going to, very thorough, very lengthy theoretical discussions. We will not do that. We will touch on the theory to some extent to get some understanding about the basics, but otherwise we are not, like any other economic subject, we are not going to go details of the theory. Instead, based on the theoretical and some practical aspects, we are going to understand the operational mechanism of the financial system. So that is our broad objective of this subject. Why we do that? Because our subject is designed to provide knowledge of this operational mechanism of the broader financial system in order to give some understanding or enable the people who are studying this subject to understand and choose their specialized fields in the coming levels or in the next levels for their better performance and career development. So in that sense, this subject will set up the basis of this entire course. So our subject, if you look at the coverage, is related to various aspects of the banking system and the financial system. We are not only dealing with one particular area. So we will be touching some various aspects of the financial system, and those aspects you will be studying in a specialized manner, or you will be studying in detail or in depth in other subjects. So in this subject, we will be laying the platform or the basis for you to understand these specialized fields. Why do we do that? Because we want to create some brilliant, excellent professional in the banking and finance field. So what we are producing here in the in our country or at the IBSL should be able to contribute to our economy as a as an expert in the banking and finance field. May not be limited to our country, may be somewhere else, but broadly someone who is contributing to the financial sector will be our final product. So that is our task at the IBSL as well as at the throughout this course. So you will be basically creating an expert throughout this program. So our subject is giving the or laying the platform for that journey. Okay. Uh, Now let me go through the subject very briefly, because this subject coverage, what we are basically showing here, will be discussed in detail in coming weeks. I think roughly we have 14-15 weeks, which means roughly 3.5 months for this entire program. During that period of time, we will be covering these aspects in a detailed manner. So we will start with a brief discussion of the role of the financial system in the economy. Actually, that will be the discussion today, some overview of the financial system. And then we will look at money in detailed manner. I told you at the beginning also, the foundation of this subject, the very first beginning of this subject is money. So we will be looking at the evolution, functions, money printing process, money supply, demand for money. So various aspects we will be discussing. And mind you, this subject, the unit money, is very important, because I think roughly 1/4 of this course, which means a quarter of this course, is running on the topics of money. So during next 2 to 3 sessions, we will be discussing about money, and also in our paper we have some calculations related to this money. So we will look at some computations in terms of monetary aggregates, in terms of its analytical aspects. Likewise, we will have some calculations only for this part. And as I said, that will be running for roughly 2-3 weeks. And then we will expand our discussion into various aspects of the financial system. Now, financial system, in the following slide you will see, when you say a system, there are various components related to the system. So in this system, we will be looking at such components. For example, we have payment and settlement systems in the financial system. For example, a check payment, how it happens. Simply when you present a check, that check gets realized, or which means you encash the check through a process. If you go to a shop and present a card, right now these days, these card payments are very popular under these social distancing and all these health regulations. We talk about these contactless payments, right? Which means without touching cash or without touching any device or whatever, you simply make transactions through various online modes. So we have to have some understanding how these things are happening, because it is basically happening through the financial system. Some processes, some instruments, some settle systems are there to support these things. So we will look at this payment system, and then we will look at the financial markets and securities or products. We call them as products as well. We have to look at those things. Now I think every one of us has a deposit, isn't it? Right? Maybe your parents have opened a passbook for you when you were a kid. Maybe when you started working, you opened an account, right? Maybe if you are a senior person, you might be having a kind of a term deposit. Likewise, deposits are very much common, and we are very much familiar with those things. Now, other than the deposits in a financial system, there are various instruments. Those instruments are depending on our need. For example, if you want to make an investment, you have certain instruments for that matter. For example, you can do a stock investment, buy shares. You can buy bonds. Basically, you can buy government bonds or private bonds if you want to do an investment. You can buy unit trust. You can buy any other product if you want to invest. Similarly, if you are a firm, or if you want to have some short term money, you can have instruments like repo, reverse repo instruments. If you are a person who's engaged in foreign currency, you are an importer, exporter, or if you are a dealer, maybe you have some transactions in the foreign exchange market. And also, if you are an advanced financial institution who wants to minimize your risk and you want to make some hedge, maybe you can look at for financial derivatives, structured products. Or if you are very much interested for some superannuation products like pension products, you want to have a good plan for your retirement age, you can look at for pension products. If you want to have some buffer insurance against any unforeseen thing, you can have an insurance product. Likewise, depending on your need, there are various instruments or products in the financial market that you can look at. So we will look at those things in a detailed manner. And also we will look at financial institutions. Now, in a financial sector or a system, there are various financial institutions. I think many of us, or all of us, we know about banks, right? So banks are the most popular, most important, most dominant financial institution in an economy. We have, as I said, if you have a bank account, at least you have some relationship with at least with a one bank, right? And there are various types of banks in the economy, not only commercial banks. There could be specialized banks, investment banks, there could be merchant banks. Various types of banks are there. Not only different types of banks, there could be some other financial institutions like non-bank institutions. A finance company is a non-bank institution. A leasing company is a non-bank institution. So those things are there. Depending on the products, as I said, for example, insurance company, there could be insurance companies. There could be other financial service providers. For example, you want to do some money changing. You want to have some payment card. You want to have some brokerage. For example, if you want to buy securities, shares or bonds, you need to have a broker. You need to have some safe houses for you to deposit your stocks, or you deposit your valuables. So likewise, there are various financial institutions. So those are components in the financial system. For example, as I said, institutions, instruments, markets, payment mechanisms, all these are parts of this total or broader system. Not only these different elements of the financial system, we will also look at the important areas related to the financial system. One such area is basically the financial system stability. Stability is important because a stable financial system is a must, is a prerequisite for economic performance. For example, if you look at during last 10 years, one financial crisis we have observed, starting from United States, there was a financial crisis. Many of the advanced countries were affected. And we are very much worried or concerned about this financial crisis because it threatened the global economy as well. So like what we see now due to this COVID pandemic, I think even the financial markets, the broader economy, global economy, now we see some, stress or some pressure on the economics because of the current condition. Similarly, a financial crisis is also a kind of a virus or an epidemic that threatens the global economy. So we need to have some understanding about these crises. There are various crises and some resolutions, some solutions for these crises. What are the frameworks that we can adopt in order to have stability of the financial system? So we will look at those things in a detailed manner. And also related to the financial system stability, and in terms of protecting the different parties of the financial system, we have some mechanisms to safeguard them. So we call them as financial safety net mechanisms. For example, let's say if you have observed a bank is collapsing, when the bank is closed down, there should be a mechanism for market players or the customers to get some relief when the financial institution is closed down. Now, one very recent example is, I think if you are following the news, probably you may have seen yesterday, the central bank announced that it will cancel the license of one of the finance companies in this country. So that finance company has been in trouble for many years, and the central bank has been trying to revive the operations of this finance company, and it has given various extensions, chances and all that for the company to find out some solution. But ultimately the central bank decided, okay, it won't happen, we will cancel the license. So it has been cancelled. Now with the cancellation, the central bank has said the depositors of this company will get some relief out of the deposit insurance scheme. So that deposit insurance scheme is a safety net. Likewise, there could be some other mechanisms as well in order to support the various parties of the financial system. So we will look at those things in a detailed manner. Even today, during our discussion, we will get to know some other aspects as well. Right? So that is our subject coverage. Before I move to the discussion today, I want to tell you a couple of things. I usually say this in my classes at the beginning. One thing is, as I said, our class is an interactive session. So which means you have to participate actively. Now, even through the virtual scenario, we can make it very interactive. Probably if you have any questions going forward in coming weeks, we may, have some discussion about these, various questions that you have. If you want to ask anything, just let me know even beforehand. You can pass me some message regarding any issue that you want to discuss. That is one thing. We'll make it very interactive. And also you have to make it very interesting for you, which means you have to do some your own work. Please look at the news in the financial sector. So follow up the financial media, television, newspapers, internet, TV. There are specialized TVs for finance news, television channels. So you have to follow up these things, what's happening around you, and absorb those things, and try to live with those things. What's happening around you is really important. Make it a habit that you follow the financial market and the developments very closely. Then you will be a very dynamic financial professional when you are having very updated knowledge and very dynamic knowledge on the financial environment. So that is also needed. And also do some additional reading. That is also important. So under this subject we have some recommended readings. I'll share this information later also, but for you to give you some brief understanding, we will be basically looking at some references under this subject. One such reference is basically the Central Bank Annual Report. Central Bank Annual Report, I think if you are in touch with the market, you may have seen yesterday we had a discussion on the Central Bank Annual Report through webinar mode, and the Central Bank report is already published and it is available on the website of the Central Bank as well. And in this annual report, there are two particular chapters that we are interested in. One, chapter 7 on money and monetary policy, and second one is chapter 8 on the financial sector. So both chapter 7 and 8 are important for us under this subject. So I recommend you to have some additional reading time to time based on these annual report chapters. And also you can look at some additional references. For example, we have this book, A Survey of Financial System, written by one of the former deputy governors of the central bank, published, and it is available even at the IBSL library and also maybe in the market in libraries. So you can refer to this book as well. In time to time, I'll be specifying certain references for you to go through depending on our discussion, and that is needed for us to get some deeper understanding. And also the other thing, try to do some work additionally, which means not only participating to the class through the classroom, Google Classroom, or physically, it won't help, right? You are simply listening to what I say, or you are simply looking at the slides what I present. That is not enough. So you have to do some extra work in terms of answering questions, model questions, past paper questions. So those things are needed. I think IBSL has a very good collection of past papers, including the marking scheme. So I really recommend you to look at these past papers and try to do your own some of these past papers. Most of these past papers we will be discussing in the class environment as well. But my recommendation is, once we cover the subject material for each and every topic, probably you can take out those past papers and attempt to do those questions on your own. So that is really helpful. Do some practice. And finally, in this class we will be having a kind of a practice test, practice workshop for you to get some hands-on experience on the exam. So last time also we were planning to have this workshop, but unfortunately I think the last week of the last semester was affected by this COVID outbreak and we could not do it. But I'm sure if you do it, that will be really helpful in the exam. So it is like a mock exam, so you get to know some very similar exam questions, model questions. You do some practice, and that is really helpful for you to look at the paper in a very convenient or very uh, uh, interactive manner, where you have some very familiar questions in the paper as well, because we will be looking at the past and we will try to predict the questions in the paper. So that is really important. So that is our overview regarding this subject. Before I proceed to the balance of this slideshow, is anyone having any questions regarding the structure or regarding the way forward? Any questions you have? No? It's very clear, the structure. And the paper, in the paper we have 8 questions, usually 8 questions, and the first question is compulsory. And in that question we have, I think, 10 sub questions, small answer type questions or multiple choice questions. So the first one is compulsory, and other than that you have to answer 4 questions. So basically 8 questions. Out of 8 you have to answer 5 questions. So that is the basic setup of the paper. Okay. All right. So with that, let's move to the subject material. In terms of the overview of a financial system, right? Now, what do you mean by a system? A system you can simply define as a set of things working together as parts of a mechanism or an interconnecting network. So in a system you have different parts, and these parts are working in an interconnected manner. No system is, no part is working in isolation. The best example for a system is a computer system. So in a computer system, the monitor does not function alone, the printer does not function alone, the keyboard, the CPU, the scanner, mouse, any of these things will not function in isolation. They will function together in an interconnected manner. So those are basically networked. The computer, the CPU, the printer, the keyboard, the mouse, everything is in a network and working as a whole. That is a basic understanding of a system, a set of things working together. Similarly, a financial system is also a set of components that are working together as financial intermediaries to create and exchange financial assets. So in a financial system, very simply, if you look at in a holistic way, in a broader view, you will see there are various components. These various components are acting in the financial system to create value for assets and allow them to exchange financial assets, right? Now, what in the very first few slides I told you, there are various financial institutions, various financial products, various payment systems. None of these things are working in isolation in a financial system. They work as a network, they work in teams, or they work in an interconnected manner. What is the ultimate purpose in the financial system? It helps us to create financial assets, and also it helps us to exchange those financial assets in the financial system. So I think you have some broad idea about a financial system. You have a set of components and working together to create and exchange financial assets. So in a textbook's definition, how do you define the financial system? So here I have copied this definition from a textbook, Howells and Bain, how they define the financial system is a set of markets for financial instruments, and the individuals, institutions who are trading in those markets together with the regulators and supervisors of the system. A financial system is a set of markets for financial instruments and the individuals who trade in those markets together with the regulators and the supervisors. So by looking at this definition, what we can see, or what we can simply observe, there are some various instruments or various components in the financial system. I hope you can see the slide, right? I was trying to get the pen, but unfortunately it's not possible. But let me move the cursor, right? Then you will understand. So in this definition, we see a couple of components, important components. What are these components? A set of markets. We have markets in the financial system. We have financial instruments, as I said, a set of markets for financial instruments, and we have individuals and institutions as well. We have markets, instruments, institutions who are trading in those markets. So as I said at the beginning, the financial system is composed of various components. So those components are visible in this definition. We have instruments, individuals, institutions, and the markets, together with regulators and supervisors. So in a financial system, there are regulators or supervisors to look after the financial system. I will come back to that later, why we need those regulators and supervisors. Those are also part of the financial system. So in that sense, I think you can have a very simple idea about the financial system. It's an institutional arrangement for mobilizing funds from surplus units and channel such funds to the deficit units. So the financial system is an institutional arrangement. So in that institutional arrangement, as I said, we have markets, instruments, institutions, all these things, and also the regulators in this institutional arrangement. Why do we have this institutional arrangement? That helps us to mobilize funds in the economy and channel those funds to needy sectors of the economy. Now, when I say the economy, there are various parts of the economy who are having funds with them and also who are requiring funds. We call them as surplus units and deficit units. So in the economy, we have two units actually, surplus units, deficit units. Who are these surplus units? Now surplus units, I think you have some idea about the overall production of the economy, national economy. Let's say it is Y. Y is the total production. So total production can be, at the very basic level, you can divide into two components, total production. What are these two components? Total production, either you can consume or you can save. So in a simple economy, you can write Y equals C plus S, which means C means consumption, S means saving. So anyone can either have COS or both, right? If you are consuming more, saving less, you have more C, less S. If you are having equal amounts of C and S, you have C and S in an equal manner. Sometimes you might be having consumption, entirely you are consuming. Then you have broadly C, S is 0. But simply you can write this identity as Y equals C plus S. This S is savings. So in the economy, you are creating a surplus by saving. That part is not consumed. Think about you. Even you can be a saver, right? Whenever you earn, after you get your salary, your salary can be allocated for consumption as well as saving. So these individual savings can be accumulated in the economy, and that accumulated savings, you can call it as the surplus sector of the economy, surplus funds. And these surplus funds, you cannot keep in idle form, which means you have to invest such surplus funds. You have to generate some return out of that. Otherwise, no point of saving, right? You save because for a purpose. Then what you can do? Usually, you channel those surplus funds to the deficit units in the economy. Who are these deficit units? Again, if I go back to that C plus S equation, as I said, there could be some people who are having 0S, which means they don't have savings. Or there could be people who are having minus S, which means they are spending more than earn and they don't have any saving. So they are basically minus savers. Minus savers means borrowers, deficit units. So if you accumulate all these individual borrowers, we can call it the deficit unit of the economy. So in a broader economy, surplus unit is channeling funds to the deficit unit. In other words, savers are channeling funds to the borrowers. So borrowers are borrowing money from the savers through the financial system. Who provides this facility? The institutional arrangement provides a facility for surplus funds to be channeled to the deficit units. So those institutional arrangement is, as I said, the markets, the instruments, institutions who are helping to channel funds from surplus units to deficit units, right? Now, what I said is very clearly highlighted in this diagram. Now, this diagram is from one of the textbooks, Mishkin. Mishkin, I think you may have heard Friedrich Mishkin's. He got a lot of books in banking and finance. This is from Economics of Money and Banking, 2013 book. In that book, the figure 1, the very first figure of the book is flow of funds through the financial system. What is given in this screen, right? So as I said, in this screen, if you look at very closely, the two segments I mentioned is clearly given here. So this sector is the surplus sector, this part. Why do you call it surplus sector? They are savers. Since they are savers, they can lend. They can lend to the needy sectors. Who are these savers? Households like you and me, we can save. Business firms who are producing goods and services, they can save. For example, their retained earning is a saving. Their undistributed profits is a saving. So those are their savings. Even the governments can save. Typically, governments are not saving, they are savers, but even the government can have a surplus. They can save. Foreigners, they can save their surplus. Right? So all these four parties together form the surplus sector of the economy. Right? And as I said, there is a sector with a deficit who wants to borrow. They are basically spenders in the economy. Who are these spenders or borrowers? Again, business firms. Businesses, they want to have, borrowings for their activities. They want to, do some production. They want to have some expansion. So they need some money. For their day-to-day run of the business, they need money. Government need money. Typically, as I said, the governments are running deficits. So they need to borrow. Households, even they are borrowing. For example, a person who wants to buy a land, buy a house, buy a car, who wants to start a business, they will be borrowing because they don't have enough funds. Even the foreigners, they can borrow. The foreign sector, they might need funds. So this entire four parties together form the borrowers section or the deficit unit. So we have the surplus units on this side, deficit unit on this side. So how the channeling of funds happening in this economy? That happens through two types of transactions. So one such way is these savers can channel funds to the borrowers through financial intermediaries. Now, for example, if you have a surplus or saving, you can go to a bank and deposit. That bank is a financial intermediary. So you go to the bank and channel funds by way of a deposit. So the financial intermediary, the bank, collects surplus funds from you, and that fund can be given as a loan to the deficit unit. So the deficit unit is borrowing, which means the financial intermediary is giving a loan. So that is basically channeling funds to the deficit unit. So accepting funds from the surplus unit and channeling those funds to the deficit unit by a financial intermediary, you call it indirect financing in the economy. Indirect financing means you channel funds through an intermediary. There is a person between you as the, let's say you are the saver, and there is a borrower. Between the saver and the borrower, there is an institution supporting the transaction. As I said, a bank. The bank can accept your money and channel it to the borrower as a loan. So that is called as indirect funds or indirect financing in the economy. So indirect financing is generally happening through financial intermediaries. Financial intermediaries, basically, who are acting as middlemen to support transactions. So I have already given you an example. For example, the banks, even the non-banks, they are financial intermediaries. Insurance companies, they are financial intermediaries. Pension funds, they are financial intermediaries. Why? They are accepting money and channeling those funds to the needy sectors. So that is one way of directing funds. The other method is direct financing. Here we have given in this blue color text. Direct financing means without going through a financial intermediary or a bank, you can simply go through the financial market. For example, without depositing your money in a bank, you can buy securities in a financial market. What are the securities you can buy? You can buy bonds, you can buy stocks, you can invest in commercial papers, you can give a short-term loan in the money market. Likewise, through a market mechanism, through the market, you can directly give money to the borrowers as a saver. How can you do that? Through buying securities, right? Here in this case, you are buying financial products like loans, like deposits, like insurance product. Likewise, here you are again buying financial products or instruments traded directly in the market, like stocks, bonds, debentures, likewise. So this is called as direct finance. I hope it's clear. In the economy, there could be direct financing, also indirect financing. What we broadly observe is indirect financing means bank-based financing is very much popular in emerging countries like us. If you look at Sri Lanka, who are the dominant players? The banking sector. So the banking sector dominates the financial system. But if you look at advanced economies, compared to banks and financial intermediaries, financial markets are also very important. For example, in US market, in European markets, in Australian markets, although we have a substantial banking sector, other markets are also playing a huge role. The stock market, for example, debenture, the bond market, for example, they are playing a significant role in these markets. So I think it's clear, depending on the level of the financial system, the relative importance of the direct financing and indirect financing could be different. So indirect financing is much more popular in less developed financial markets, like we have banks, number of banks. Direct financing is getting popularized in developed markets. So that is the basic observation about these markets that we have. Okay. Now let's look at why do we need a financial system and what is the importance of a financial system. So in a financial system, through these activities, direct financing and indirect financing, some important things are happening. What are these things? So we can observe through the financial system, we can mobilize funds from the surplus units and lend those funds into the deficit units. So this mobilization of funds and giving those funds into the needy sectors, you can simply call as provision of liquidity. Liquidity means, in a broader sense, money. Okay, the term liquidity means money. It has some other meanings as well. For example, if I say money is very liquid, means money is highly convertible into cash for transactions, right? Money is anyway, it's cash. So which means you don't need to any conversion. If I say a particular security is very liquid, which means I can convert into cash very quickly. So that meaning is also there for liquidity. Here we refer to liquidity means the ability to provide financing needs, provision of liquidity. So which means money. Okay. And also the financial system is important for us to offer various financial products and services. I showed you not only deposits that we have in the financial system, there could be various products, deposits, bonds, stocks, other short-term instruments, loans, derivatives. There could be various types of financial instruments operated in a financial system. So that is basically provided in the financial system. Third one, financial system is important for us to identify market prices. Market prices for what? Financial assets. So in a financial system, financial assets are traded. People are buying financial assets. People are selling financial assets. For example, if I have a stock, I can sell. If I want to buy a stock, I can buy. So this buying and selling is happening through what? Through the market process. That market process, you call it as a mechanism to discover the price. Through this market mechanism, through buying and selling process, we agree for a certain price. We agree to a certain price to exchange our financial security. So you call it price discovery. And in economics, anyway, the market transactions are helping us to discover a price, because through the demand and supply forces. So if there is a high demand, there is a tendency for prices to go up. If there is a high supply, there is a tendency to prices to go down. But at any point, there will be an agreed price, equilibrium price, through this demand supply process. So you call it price discovery. That is happening in the financial market as well. And also, the finance is always relevant or coming with risk. There is risk always associated with finance. Without risk, you don't have finance. What do you mean by risk? Risk is simply the possibility of making losses, or the probability of creating losses. So the risk means it's uncertain. Probably you can make a loss or not. That uncertainty is there. So that is very inherent for finance. Financial sector is always carrying this risk. But we are not simply staying, in a lazy way, saying, okay, there is a risk, we cannot do anything. It's not the case. We are trying to, avoid or minimize this risk through certain activities. So as a result, we are trying to price the risk. We are trying to pool the risk, which means you combine various, risk instruments, and we try to trade the risk. We try to, enter into a deal to share the risk, right? So that part we call as transformation of risk in the financial system. And also, I already mentioned to you, financial system is helping as a clearing system. Clearing means simply it helps us to make our payments and do settlements. If you want to, make a payment to a certain security, if you want to make a certain payment to some person, you can do it through the financial system, through the banking mechanism. So the financial system is helping us to make this, uh, to uh, to do this clearing. And also, financial system is processing information, then generating information. It is very much popular in modern days. Now, in the past, information is, it's not everywhere, right? Because we did not have much of the modes for us to, access information. But now, there are various ways to, access information. Similar way, financial system is, very easily generate and disseminate information. Who needs this information? The market players. If I am an investor, if I am a borrower, if I am a depositor, I need information in the financial system. So through the financial market activities, the information dissemination is happening. So in economics, we call this as resolving information asymmetry problem. Information asymmetry means we are having, unequal distribution of information. As an investor, I have a certain set of information. You are also an investor, but you don't have enough information. So there is an information gap. I'm having more information, you are having less information. So when I have more information than you, that is asymmetry. So in a financial system, in order to have a fair transaction, in order to have, a beneficial transaction for both parties, there should be information symmetry, which means we have similar information when we deal in the financial assets. So the financial system is helping to find out this information. So in summary, why financial system is important? It helps us to provide liquidity. It helps us to discover the prices. It helps us to trade the risk or transform the risk. It helps us to make our payments and settlements, and also it settles or resolves the information asymmetry problem, right? Now, with all these things, what is the role of the financial system? Now, in order to understand that, we can look at some evidence. We are saying financial system is the backbone of the economy, which means financial system is supporting the real economy. Remember our very first, slide, we told that financial system is supporting the real economy. Financial flows are supporting the real flows. Some people say real flows are backed by the financial flows, because real transactions will not happen if there are no financial transactions, right? So in that sense, it is very much linked with each other. So it is the backbone. Some people say financial system is the blood of the economy. Why? You need blood for the circulation of, blood circulation is needed for you to function your organs in the body. Similarly, in the economy, you have to have blood. There should be a circulation of blood to have a functioning of the organs of the economy. So that's why we call it backbone or blood of the economy, the financial system. And empirically means through research, we have seen there's a close relationship between the financial sector and the real economy. So in this chart, I'm extracting this chart from the Federal Reserve Bank. Federal Reserve Bank means the United States Central Bank. And in that central bank. There are some regional central banks, which means in the federal states there are different banks. So St. Louis is one of the Federal Reserve banks, one of the regional banks. In one of their research publications, I find this chart. What is this chart? You call this chart as a scatter plot. Scatter plot means you simply plot different data points in two-dimensional or two-axis chart, right? So these dots indicate, a different combinations of these two variables. So what are these combinations? We have on this axis in this chart GDP per worker. On this axis we have external finance to GDP. So these are some proxies. Proxies means we use these to represent some variables. So this variable represents GDP per worker, represents growth, right? This variable, external finance to GDP, represents the finance, level of financial, let's say financial depth, the level of the financial system, anything, right? So basically finance. This axis growth, this axis finance. This each and every dot I told you combinations of these finance and GDP. So what are the combinations we see in dots? They are different countries, right? So if you plot these countries and if you take a trend line, the red line, what you will see is basically a positive trend line, a positive direction. What does that mean? GDP and finance has a positive relationship. In other words, when you have more GDP, you have more finance. If you have more finance, you have more GDP. We don't know which one is first, right? It's like chicken and egg problem. Who came first? We don't know whether it is chicken or egg. Similarly, we don't know which one is causing which one. But the relationship between the GDP and finance is a kind of a positive relationship. You can argue when there is finance, there will be GDP expansion, growth. When there is GDP, high GDP, there will be finance, right? Similarly, the right-hand side chart also, the same thing. On this axis, we have productivity. Total factor productivity means productivity. Simply productivity means what is the output you generate for 1 unit of input. So what the chart suggests, when you have more finance, productivity is higher. Or in other words, when you have more productivity, finance, level of finance is higher. So both chart indicates there is a positive relationship between finance and growth. Okay, so there is some proof, some evidence for us to justify the importance of the financial system. So financial system is a really important thing for the economy. So that is the message. And in this financial system, how it supports growth, how it supports economic activity. Now we know in the economy how the economic activities are happening through entrepreneurs. Entrepreneurs means who are basically running the economic activities. In the economy, these entrepreneurs, we consider them as investors or borrowers because they are the people who get funds from the financial system and run the economic activities. But unfortunately, these individual entrepreneurs, they don't have enough capital to undertake investment. If I am an entrepreneur, I might not have enough capital with me. I don't have enough savings with me to undertake economic activities. So I need some money to undertake my activity. For example, if I want to start a factory and do production, I don't have money. I should get some money from some external party. Remember, I told you we have a surplus sector, we have savers. What about them? Even those individual savers, they are expecting some return for their money. But if they keep money with them individually, will they earn anything? No. So individual savers cannot increase any return for their money. Right? So as a result, what they will do? They are pooling their money. How do they pool their money? They pool their money in financial institutions, financial markets. Remember, I was talking about direct financing and indirect financing. So through the direct financing or indirect financing methods, these individuals are pooling money, accumulating money. And that money is borrowed by those individual entrepreneurs, as I said, investors, borrowers, right, for their activity. So in that sense, the problem of individual entrepreneurs and individual savers in the economy is resolved by the financial system. How? It helps accumulating capital from small savers. Through the banks, through the financial system, you can accumulate capital. And you allocate that capital to the users. Who are the users? Those entrepreneurs, investors, who runs business. You allocate capital. How do you allocate capital? Maybe through a loan, maybe through a bond, maybe through stocks, whatever the instrument is, you can allocate capital to those users. Not only that, you are accumulating, allocating, and also the financial system is monitoring whether that allocated funds are being used for these activities. For example, if a bank gives a loan, there is a way of monitoring how these funds are used. So accumulating, allocating, monitoring is the basic function of the financial system to resolve the problem of individual entrepreneurs and savers. In that way, we can broadly say the financial system is facilitating the allocation and deployment of economic resources. So the resource allocation is done by the financial system. Okay? So how this happens in a modern financial system? How do you allocate? How do you monitor? How do you basically support this problem solving in the financial system? So in a modern financial system, we identify 4 important services by the financial system. So I recommend you really keep a note on this slide 17. If someone asks, what is the role of a modern financial system? Your answer should be based on these 4 activities, right? These 4 activities. So what are these activities? The financial system is helping to value exchange in the economy. Value exchange means simply you make payments. You make monetary payments, you make check payments, you make online payments, anything. So this payment mechanism is helping us to value exchange in the economy. Second, we have already discussed intermediation. Intermediation means the financial system is helping to transfer funds between savers and borrowers. Credit provision, or remember I told you the word liquidity provision, intermediation. Risk transfer, we have already covered pricing and allocating the risk. Okay. And the last one, helping to convert assets into cash. You call it liquidity or liquidation, right? Don't mix up that idea with intermediation. I told you intermediation means also providing liquidity, providing money. Here the idea liquidity is you are helping to converting assets into cash without any undue loss of value, right? So in that sense, we can simplify or summarize the discussion that we had so far. A modern financial system is providing these four important services in the economy: value exchanging, intermediation, risk transferring, liquidity, or providing facilities to convert assets into cash, right? Okay, so that is the basic understanding about the financial system. Why we need a financial system, what is the role of the financial system, how the financial transactions are happening in a financial system, and what is the link of the financial system with the broader economy. So this part actually in our paper, in every paper you will see a question related to this part. For example, there could be a question, why do you think that financial system is important for the broader economy? I hope you can answer that question based on this discussion. Or there could be a different question. For example, what are the functions of a financial system in a modern economy? Or what are the key attributes of a modern financial system? Likewise, there could be questions related to the broader role of a financial system at the very beginning of your paper. I think every paper has a similar question to these, questions that I mentioned. Role of the financial system. Okay. Then let's move to the next part of this discussion. What are the components of the financial system? We are basically focusing our discussion into our own context, which means the Sri Lankan context. In any country, you will observe these components, different components, but our discussion on these components will be done with a specific focus on our Sri Lankan financial market, because our knowledge is mainly applicable or will be used in our Sri Lankan financial market. And in order to understand the market dynamics, it is important for us to use our own example. So that is the reason for us to use examples from the Sri Lankan financial market. But time to time, we will be looking at the global markets as well, okay, depending on the need. So we will have basically Sri Lankan focus in our discussion. Therefore, we need to have sort of understanding about the Sri Lankan financial market as well. Now in Sri Lanka, if you look at the financial system, we know, being a country with a notable history spanning for more than 2000 years at least, we know we have been a country with a relatively sophisticated financial system. Why I am saying like that? If you go back to our monetary history, you will see we have been using money for our economic activities. If you look at historical evidence, even in the first, second, third, fifth century, we see the coinage was there in Sri Lanka. People use coins, right? And some written documentation confirms us that we had been running a relatively a good financial system. Even the concept of banking was there in Sri Lanka. Some of the inscriptions means these shilalekan, right? Those suggest that we have been running some banking concepts in Sri Lanka. For example, the very old Thonigala inscription, the Thonigala Ampara Shilalipiya, that tells us the concept of banking sometimes back in Sri Lanka. So which means we had an old financial system in Sri Lanka to support economic activity. So what was the main economic activity we are talking about is trading. Sri Lanka has been a trading hub with many parts of the world, especially with the East, right? And we have been in the kind of a central location for this trading. So in that sense, we have been running with a relatively sophisticated financial system. But we are not talking about that financial system here, because our focus is basically about the modern financial system in Sri Lanka, the current financial system. So current financial system, we can basically look at since the independence, which means since 1948-49, that period, we can look at our financial system up to now. So what are our observations? Now, we can divide our financial system into actually three distinct phases, three distinct periods. First, 1948 to, let's say, 1977. That is the first part of the history. Then 1977 to late 1990s. That is the second part. And then since 2000s to up to now, right? So those are the three broader periods. What do you observe during these three periods? We observe since 1948 to let's say 1977, you can vaguely say up to 80s, early 80s, our financial has been broadly regulated. We use this term regulated. What do you mean by regulated? The idea of regulation means highly controlled. The financial system has been very controlled, under control environment. How do you monitor whether it is a controlled environment? The activities of financial system is mainly driven by state or the government leadership, government role, or their regulations. So during this period, we observe the role of the government is significant. For example, the main banks in the country, they were government banks, right? State banks. The main assets of the financial system was held by the government. So basically the government driven financial system. So as a result, there was very limits in the financial system. Private sector cannot simply enter into the financial system. There were controls on interest rates. Banks, they cannot simply determine their interest rates. It is determined by the government. As I said, the private sector cannot open their branches, or the foreigners cannot come and simply open bank branches here. The stock market activities are very limited. Even foreigners cannot come and do any trading. And also banks are given some directions. You have to have low interest rates. You have to give loans as at this interest rate. You call them as concessional loans. Likewise, so every financial activity is broadly controlled during this period. But since 1977, Sri Lanka adopted a policy called economic liberalization. I'm not so sure whether you are very young or very senior person or whoever is joining the session. I don't know. But if you have read or if you know something about that period, 1977, early 80s, that was the period we started liberalizing our economy. Liberalizing means you are simply allowing foreigners to come and play a role in the domestic economy. How do you allow foreigners to come and play a role? You allow imports, you allow exports, you allow foreign investments, you allow foreign banks to come. Likewise, various opening of the economy was happening since 1977. So you call it economic liberalization. In terms of the financial system, what do you observe? This liberalization, regard to this liberalization. As I said, interest rates were controlled during the previous period, but now we allow banks, financial institutions to determine their interest. Right? No direction from the government. Earlier, no one is able to come and set up a bank. Now, you allow banks to, enter into the Sri Lankan financial market. You allow private banks to open. You allow foreign banks to come and open, right? Under certain conditions, but still you allow the foreign participation. And you phase out interest rate subsidy schemes. I told you a lot of concessional loan schemes were there. So you allow, you phase out those things, and which means you allow market to play a role, no controls, right? And you allow market driven financial products. The only product we knew for a longer period is basically deposits. Not only deposits, you can have, various financial products, insurance products, pension products, derivative products, bonds. Likewise, you expand the scope of different financial instruments. You allow stock market to, play a role. You liberalize the market. I think in 1990s, early 90s, we opened our stock market for foreigners. So foreigners came and they were able to invest in our stock market. They can, earn profits in our local stock market. They can take back their profits into their countries. That is also possible, right? Liberalization. And also, we strengthen our regulatory frameworks, which means earlier the regulation was basically, to restrict the institutions, to restrict their actions. But under new environment, you strengthen the regulatory framework to support the institutions, to support banks, to support markets. Likewise, you give some support for them to expand their activities in the economy. So that is under this liberalization package. And I told you a third period as well, especially after 1990s, what we have seen during this period, we see a further opening of the Sri Lankan economy to the global economy. For example, during this period, we allow foreigners to come and, basically invest in our government bonds also. We went into foreign markets and we launched selling our bonds also during this period. So further liberalization of activities. And also during this period, the third phase, we see a lot of electronic money and electronic finance, electronic activities are becoming very important. I think you may have heard the first ATM card was introduced somewhere in 1987. So that was the first electronic device we observed in our market. So since then, now today we know the banking activity has come into our mobile phone. It has come into our watch, wristwatch. Likewise, the technology and communication has transformed the financial sector activities during this third phase. So it is very comprehensive, very technology driven during this third phase. So if you look at very in a simple manner the timeline. In the first part, we see a lot of regulation, a lot of controls. In the second part, we have allowed those controls to be relaxed and more activities. And in the third phase, we allow more technology driven expansion. We allow more digitization. We allow more innovations during the third phase of this financial transformation, right? I hope that gives some clear idea about our uh, process of the financial transformation in Sri Lanka, right? So with that overview about our financial system, now let's look at the structure of our financial system. I told you this structure is the entire discussion of our subject. During next few weeks or few months, we will be discussing these elements in the financial system in a detailed manner going forward. So that is our plan for the next period. So if you take the broader system, remember we were starting with a system. I told you in that system there are various components connected to through the network, through connecting each other. What are these elements? Those elements, you can call them as components of the financial system. What are the components we have? We have regulatory authorities. Remember that definition, textbook definition of the financial system. You have to have regulatory supervisory authorities in a financial system. So regulatory authorities are simply people or institutions who's overseeing the financial system. I think in the following slide we have very details. In a detailed manner we will be discussing, but here basic understanding. What are these, or who are these regulators? Now, for example, a central bank. Central bank is the key regulator of a financial system. In addition, there could be other regulatory authorities as well. For example, in our country, we have Securities and Exchange Commission to regulate the stock market. We have Insurance Commission to regulate the insurance sector. In some countries, not only the central bank, they have authorities called Financial Services Authority, which means to oversee the or to regulate the financial institutions, right? So that is basically the regulatory component. Then we have financial institutions. Financial institutions means who are basically dealing in financial assets, who are creating and exchanging financial assets. There are various institutions. I think, as I said, banks are the most common, and we have non-bank institutions. We have other service providers. We have various investment type of financial institutions. So those are forming a one component of the financial system. Then we have financial markets. As I said, financial instruments are traded in the markets. Bond market, stock market, foreign exchange market, money market. In those market segments, there could be primary markets, secondary markets, wholesale markets, retail markets. So any of these markets will help us to trade our financial instruments, right? And what are we going to trade in these markets? We have financial instruments. As I said, not only deposits, there could be various instruments. There could be bonds, there could be commercial papers, there could be loan products, there could be derivatives. Likewise, there are various financial instruments traded in these markets. Okay, and then we have payment and settlement infrastructure, where we have some mechanisms for us to deal or make our payments or to do our transactions. Those are some platforms for us to undertake our activities, undertake our transactions. For example, if you present a check, how that check is being realized. So that is through a payment mechanism. Then we have safety nets. As I said, if you are in trouble in the financial system, there should be some mechanisms for us to have some relief in terms of the uh, shock that we face, right? So those are the safety net. So likewise, these broader components together form the financial system. If any of these component is missing, then the financial system will not work properly. Now, for example, let's say we don't have this payment and settlement infrastructure, then how other components work? It won't happen. Let's say we don't have financial institutions, how the other components work? It won't happen. Now, let's say safety nets. Earlier, we did not have safety nets. This was a recent addition, and we realized none of these components will not work properly if we don't have safety nets. So, in that sense, each and every component is really important, right? So, from this slide onwards, we have basically, given you some understanding, some discussion about these different authorities. So I have already mentioned these points when I was talking about these regulators and all that, why there is a person called regulator, why it is important. All these are discussed in the following slides relevant to our discussion. For example, now in Sri Lanka, who are the lead regulator that we have is the central bank. I already mentioned to you. Central bank is oversee the majority of the financial system because it looks after the banking system, it looks after the non-bank system, primary dealers. Likewise, the central bank is looking at the broader financial system in a holistic manner, and it has very large significant role to play because of the institutions that supervised by the central bank. And other thing I want to mention, it is done through various legal enactments. So legal backing is there for the central bank. For example, central bank is doing bank regulation in terms of Monetary Law Act and the Banking Act. Central bank monitors finance company based on the Finance Business Act. It monitors leasing companies based on the Leasing Act. Likewise, the central bank is having various legal backing to regulate the institutions in the economy, being the lead regulator. And also, as I said, not only the central bank, there are some other regulators as well, because these companies are not supervised by the central bank. For example, stockbrokers are not supervised by the central bank. Unit trusts not supervised by the central bank. Insurance companies not supervised by the central bank. Then who are the other regulators? As I said, we have Securities and Exchange Commission. Under Securities and Exchange Commission Act, it monitors all these stock brokers, stock exchanges, credit rating. All these are monitored by the Securities and Exchange Commission. Insurance Board, it supervises the insurance companies, right? And then we have financial institutions. As I said, we have starting from banks, there are various financial institutions, finance companies, leasing companies, primary dealers, insurance companies, likewise. So here in this slide, we have the breakdown of these institutions. We have four major sectors of financial institutions in Sri Lanka. We have a banking sector, we have other deposit taking institutions, We have specialized institutions, we have contractual institutions. So their significance, their size is given by these numbers, right? So this table is directly from the central bank annual report, the latest version 2019. So these numbers tell us who are the big players in the Sri Lankan financial market or the institutions. So I take this picture from the central bank annual report. Who are the largest financial institutions in Sri Lanka? Banks. Here, if you look at 62% of the assets are held by the banking system, commercial banks and specialized banks. And then we have the EPF and superannuation sector, including the so-called employees provident fund, right? So it has 15% of the assets. The central bank is having 10%. Finance companies 8%. Insurance companies 3%. Other like primary dealers, stockbrokers, all these are having 2%. All in all, our total size of the financial sector is 20 trillion rupees right now. Out of that, the banking sector is the largest. So that's why I said at the beginning, we are basically a bank driven economy because banks play a huge role. So here I have listed down these financial institutions, and as I said, the banking sector is playing the larger or the bigger role, commercial banks and the specialized banks. So in the following slides, I have explained these commercial banks and specialized banks. So they are dominating our financial system. And I told you we have a number of commercial banks and licensed banks, specialized banks. Roughly 32 banks are there. And out of these 32, there are 6 large banks operating in Sri Lanka. We consider them as systemically important banks. They are the largest banks. I think you know some of these banks: People's Banks, Bank of Ceylon, Commercial Bank, HNB. Likewise, 6 major banks are there. So I have given you some, introduction to these banks in these following slides. About commercial banks and the markets. Now in Sri Lanka, we observe 5 major financial markets who are dealing in credit and capital. What are these 5 markets? We have a money market, we have equity market, we have private debt market, the government securities market, and the foreign exchange market. So in this money market and equity market, debt market, government securities market, in all these markets are serving for different purposes. I will discuss these things in detail when time to come. For example, money market is serving for short-term needs. Equity market and debt market is helping for long-term financing needs. Foreign exchange market is helping for foreign exchange needs, right? Likewise, it is serving for different purposes. So we will discuss those markets in detail. So in this slide, I have given you some understanding about the money market. As I said, short-term market. Capital market is basically the long-term market where you trade bonds and equity. In money market, you basically trade bills and simply money, right? And then you can classify these markets into various aspects based on their instrument. You can classify them as debt market, equity market, or depending on the type of the transaction, whether it is a primary market, secondary market, likewise you can classify. So here, as I said, we have listed down these markets. And these financial markets are having some relationship with the central bank activities. So whatever the action taken by the central bank is affecting these markets. So there is a close relationship between these markets and the central bank. So we will discuss these when time to come. And then instruments, as I said, there are various instruments in the financial system: deposits, loans, bills, bonds, repurchase agreements, shares, corporate bonds, commercial papers, and also some new type of instruments: asset-backed securities, financial derivatives. Those are in the financial system for us to do a transaction, right? So we will cover those things in detail in a separate discussion. And then we have payment and settlement infrastructure. They are different systems for us to execute large value or small value payments. So whatever the payment we want to make, whether the size doesn't matter, the financial system or the payment system helps us to do that. One of the important thing that we expect from the payment system is there should be safety and efficiency. So safety and efficiency is ensured by the technological improvements. So based on technological improvements, we observe there are various payment mechanisms in the financial sector. We have check clearing systems, fund transfer systems, RTGS system means real-time gross settlement system, means for large value payments. We have scriptless and security settlement systems, which means for security transactions, bill bond transactions. We have security depositories, which means you can store your securities for some time. You can trade your debt, you can trade your equity. All these are forming the payment and settlement infrastructure. Broadly, you call it as financial infrastructure, right? Financial infrastructure. So we will look at this financial infrastructure in a detailed manner. For example, in Sri Lanka, we have some important systems for our transactions. For example, we have a check imaging system. We have an interbank payment system. For example, how do we get our salaries every month? When your employer credits your account through the slip system. If you buy a treasury bill or a bond, how do you make the transaction? That happens through Lanka Settle, this RTGS, Lanka Secure system. So those are some important systems that we have. And finally, as I said, we have a lot of safety nets for us to have some security. As I said, we have bank regulation and supervision. We have deposit insurance schemes. We have emergency funding needs. And also if there's a crisis, there is a mechanism for us to have some resolution in the face of a crisis. We call them as safety nets that we have in the financial system, right? Why we need to have a safety net? We are very much worried about financial systems with a stability. We have to have a safe and secure financial system that can face external and internal shocks without any vulnerability. Because if the financial system is vulnerable, that will create imbalances in the economy. I told you at the beginning also. So if the economy is having imbalances because of the financial system failure, there won't be any support from the financial system for the growth. So the investment and economic growth will be affected if there is a destabilized or unstable financial system. So we are worried about a stable financial system. This stable financial system is ensured by the safety nets that we talk about. So during last 10-15 slides, I went through very quickly to give you some overview about the components in the financial system that we need to discuss under this subject. So each and every component we will be discussing in a detailed manner. some discussions will go through 2-3 weeks of each component, and we ensure that we will have a very thorough understanding, deep understanding on these different components, right? And next week we start with our discussion on money. Okay, so that is our major component of the financial system. Remember, our very first regulator is the central bank. Remember, central bank here, central bank. So central bank is related to money. So we need to understand money in a detailed manner. That is the basis for the financial sector. So next week we are going to start with our discussion with money. So I really encourage you to, if you have some time, try to look at the central bank annual report chapter 7. It is all about money, and you will have some basic understanding before you come to the class, right? And we will have a very fruitful discussion about money. Okay, so I think I have utilized my 2 hours by now. It's almost 4 minutes past 4, and here we have spent some effective, some useful 2 hours for you to give for give some broad understanding about our subject and the subject material, and also the financial system. And starting from next week we will have a thorough discussion on each and every aspect. Okay, and I hope you will have a safe time. Stay safe and use your time effectively. If you are working from home, use your time very effectively. And I think this is the best time for you to realize the importance of the financial system as well, okay, when you are working from home. Thank you very much, and I'll see you next